On December of 1928, President Coolidge, in his last State of the Union, boasted that the United States had the highest record of years of prosperity. There was much that was good about the world of which Coolidge spoke, but little did he know about the storm that was brewing. The Great Crash of 1929 was a unique one. Unlike other stock market crashes, the crash of 1929 continued and got violently worse. This was the unique feature of the 1929 experience. After the crash came the Great Depression, which lasted for over 10 years. So what caused the Great Crash of 1929 and what were some of the consequences? Let's take a step back to 1924. The stock market began its rise in the last 6 months of 1924. The rise continued in 1925, and around 1927 there was a huge surge in the stock prices. It is said that 1927 is the year when the seeds of the eventual disaster were sown. Money was very easy to borrow, which encouraged people to borrow money from the banks and use that money to buy securities in hopes of getting rich quick. This easy money policy continued in 1928, where there were huge gains in the stock market. In November of 1928, President Hoover was elected and there was a victory boom in the stock market. Apart from the fact that President Hoover was elected as the new president, there was nothing particular to entice this enthusiasm and increase in stock prices. Then on September 3rd of 1929, by common consent, the great bull market of 1920s came to an end. People were not buying stocks on fundamentals. They were buying in anticipation of rising share prices. Rising share prices simply brought more people into the market and convinced people that it was easy money. Everyone wanted to get in and get rich quick. October 28th of 1929, also called the Black Monday, the Dow Jones Industrial Average plunged nearly 13%. The market fell another 12% the next day, which is also called Black Tuesday. Dow Jones Industrial Average continued to fall until July of 1932, where it hits its lowest point, although the Great Depression continued for many more years. What were some of the causes? Well, for one, there was a phenomenal increase in trading on margin, meaning that people were borrowing money to buy stocks. The amount of speculation was at a high in 1928. Broker loans increased from $1 billion to $1.5 billion in early 1920s to around $3.5 billion in 1927 to just over $6 billion by the end of 1928. People were swarming to buy stocks on margin. The concept of buying on margin allowed ordinary people with little financial acumen to borrow money from their stockbroker and put down as little as 10% of the share value. Never had there been anything like this before. A roaring boom was in progress in the stock market, and like all booms, it had to end. Secondly, in August of 1929, just before the stock market crashed, the Federal Reserve raised the interest rate from 5% to 6%. Some experts claim that this steep and sudden hike cooled down investor enthusiasm, which affected the market stability and sharply reduced economic growth. But perhaps equally importantly, industrial and factory production was down and home building had been falling for a few years. There was also an ongoing agricultural recession. Farmers struggled to make an annual profit to keep their businesses afloat. Then lastly, the late 20s also saw a huge surge in investment trusts. Investment trusts invested the general public's money into the market. In the early months of 1929, these trusts were being formed at a rate of approximately one each business day. On top of that, these trusts were heavily leveraged. Among these trusts is a name that we're all familiar with, Goldman Sachs. Most economists agree that there was no single cause for the turmoil and that there were many compounding factors that led to the Great Crash of 1929. The stock market crash and the resulting Great Depression had a direct impact on nearly every segment of the society and altered an entire generation's perspective and relationship to the financial markets. In a sense, the time frame after the market crash was a total reversal of the attitude of the Roaring Twenties, which had been a time of great optimism, high consumer spending, and economic growth. The crash of 1929 was followed by the Great Depression, which lasted for over a decade. Many investors and ordinary people lost their entire savings, while half of the country's banks had failed. Many companies went bankrupt. At one point, some 15 million Americans were unemployed, which at that time was nearly 20% of the US population. Even suicide rates had skyrocketed. Had the economy been fundamentally sound in 1929, the effect of the great stock market crash might have been small. The shock to confidence and the loss of spending by those who were caught in the market might have soon worn off. But business in 1929 was not sound. On the contrary, it was extremely fragile. The singular feature of the great crash of 1929 was that the worst continued to worsen. What looked one day like the end proved the next to have only been the beginning. Nothing could have been more ingeniously designed to maximize the suffering and also to ensure that as few as possible escape the common suffering. Now, could something like this happen again with all the regulations in place? The chance for recurrence of a speculative orgy remains good. No one can doubt that the American people remain susceptible to the speculative mood. A rising market can bring a reality of riches. This in turn can draw more and more people to participate. Will history repeat itself? Only time will tell.